Welcome to the deep dive. Today we're acting on your requests to look a little deeper at the current market hype. We're analyzing sources that suggest three of the biggest trends out there might be headed for a spectacular and simultaneous collapse.
It's a really compelling idea and, frankly, a pretty historic one if it plays out. If you look back over the last few decades, the growth of the S&P 500, the NASDAQ, it's usually been driven by just one single seismic innovation at a time.
Right, exactly. Like the internet in the mid-90s, that was a singular force. It didn't just tweak business models, it completely redefined the market.
It did. It tore down that information wall between Wall Street and Main Street.
And that's what kicked off the whole retail investor revolution we're still living in today.
Yeah, and since then, we've seen so many next big things. Remember, genome decoding, nanotechnology, 3D printing.
Oh, yeah. The metaverse, blockchain.
All of them arrived with this huge fanfare, but very few actually achieved that immediate widespread use that, justified the initial hype. They all needed more time.
But the sources we're looking at today suggest something different, something unprecedented, really. We're not just talking about one big hope. We're talking about three huge, game-changing trends all happening at once in 2025.
We're looking at artificial intelligence, quantum computing, and this new Bitcoin Treasury Strategy.
And the risk here, the core of this whole deep dive, isn't just that there's a lot of froth in the market.
No. The concern is that all three are showing these serious, measurable signs of financial fragility. And the suggestion is they could all break down at the same time, creating a kind of triple bubble burst scenario sometime in 2026.
So that's our mission today. We're going to look past the promise, dig into the performance, and follow the numbers. I'll start with the biggest one, the one dominating every headline: artificial intelligence.
AI. It's often called the technology that investors have been waiting 30 years for. And the promise is enormous, right? Systems making split-second decisions with no human oversight.
The long-term future seems indispensable. You can't argue with that.
Indispensable, yes. But, and this is the big but, this is where we run into that historical wall. The problem isn't the tech itself. It's what we call the maturity timeline trap.
Okay, what is that?
It's this historical flaw. It's plagued almost every single major tech revolution. Investors consistently, reliably overestimate how quickly a new technology can be widely adopted in a profitable way.
And the sources say this is happening right now with AI.
That's what they're showing. Sales of AI infrastructure, the chips, the hardware, they've been through the roof. But it's really unclear if businesses are actually generating a positive return on these huge AI investments they're making.
So companies are spending a ton of money just to keep up, just to be in the game. But the actual revenue or the efficiency gains, they aren't there yet. That sounds like a recipe for a major hangover.
It is. And that delay, that gap, leads us straight to the valuation problem. How do you, as an investor, justify the astronomical prices attached to these leading AI companies?
I'll use an example. The sources point to Palantir Technologies.
Right, Palantir, the data mining specialist. Their Gotham software is used all over the U.S. government. On paper, a huge AI success story.
Seemingly, yeah.
But if you look at the financials they flagged, as of late last year, Palantir's trailing 12-month price-to-sales ratio, the PS ratio, was 102.
Whoa, okay, stop. We have to break that down. A PS ratio. What is that, and why is 102 so shocking?
It's a simple metric, but it's so powerful. It just tells you how much the market is willing to pay for every single dollar of sales a company made in the last year.
So PS of 2 means you pay $2 for $1 of sales.
Exactly. So a ratio of 102 means the market is paying $102 for every single dollar of sales Palantir brought in.
That just sounds insane. What kind of growth does a number like 102 price in?
If price is in perfection, absolute, flawless, exponential growth. Look, we haven't seen a single mega cap company in the last 30 years sustain a PS ratio over 30 for any real length of time.
And this is over 100.
When you're paying that much, you're not investing in reality. You are speculating that this company will grow at triple-digit rates for years, maybe decades, without a single misstep.
And if AI adoption hits that timeline trap we talked about, if it just takes a couple of years longer than everyone expects for businesses to really profit from it,
that valuation of 102 becomes completely unsustainable. It could lead to a massive, almost immediate correction. And that's the whole AI risk right there. The future is bright, but the market is valued like the future already happened yesterday.
Okay. So let's pivot from AI software to the second potential bubble, which is more about the hardware of the future, quantum computing. If AI is overvalued, quantum sounds like it's in another stratosphere.
Oh, absolutely. Quantum computing. I mean, using quantum mechanics to solve problems classical computers just can't. It's been arguably the hottest sector for pure speculation. We saw stocks like IonQ, Rigetti, D-Wave rally by as much as 4,490% over the trailing year.
A rally of almost 1,500%. That's stunning.
Yeah.
But the sources we have flag what they call a triple threat here. Let's start with the first two, timing and price.
Well, first, the timing. It's an even more untested technology than AI. These pure play stocks are in the very, very early stages of commercializing anything.
We're talking proof of concept stuff.
Exactly. Practical business use is years away. And second, their valuations. Their PS ratios are just stratospheric.
Let's get the numbers out there again. IonQ is at 130. D-Wave Quantum is at 246. But Rigetti Computing? Their TTM-PS ratio was 906.
906. It's jaw-dropping.
I mean, how do you even begin to justify that?
You can't, not with historical data. To sustain a PS of 906, Rigetti would need to grow their sales by 100% year after year for the better part of a decade. It's a superhuman feat. These numbers just scream bubble territory. Expectations are completely detached from economic gravity.
But I have to push back a little here. Shouldn't these companies be more valuable because they're specialized, they're laser-focused on quantum, not trying to do everything at once like the big tech giants? Isn't that an advantage?
It should be. In theory, it is. But that brings us to the third and maybe the most fatal threat: competition and capital.
Yep.
These pure plays, they're small, they're losing money, burning through cash. And meanwhile, you have the cash-rich members of the Magnificent Seven, the biggest tech players in the world, already designing and debuting their own quantum processing units, their own QPUs.
So the small guys are in a tech development war against competitors with basically infinite money and a huge existing customer base.
Precisely. If the giants decide to go all in on quantum, these little companies with all this valuation pressure and very little cash, they're just going to struggle to compete. Their specialization becomes a liability when the game is about scale and capital.
Okay, so that's two. AI, overpriced for its adoption speed. Quantum, intensely speculative and facing an existential threat. Let's shift gears completely to the third trend, the Bitcoin Treasury Strategy.
Yeah, this one moves us away from pure tech and into financial engineering, really. It was pioneered by Michael Saylor's strategy, formerly MicroStrategy, and the idea is simple.
You use cash, or you issue stock or debt.
And you use that money to buy massive amounts of Bitcoin to just hold on your balance sheet.
The appeal being Bitcoin scarcity, right? Only 21 million will ever be mined, so it's pitched as this great hedge against inflation from the expanding U.S. money supply.
And strategy went all in. As of last November, they held almost 650,000 Bitcoin. That's over $48 billion worth. It represents about 3.1% of all the Bitcoin that will ever exist. And of course, dozens of smaller companies have copied this playbook.
What's so interesting here is that the sources say the flaw isn't just that Bitcoin is volatile. It's the actual weakness of the companies doing this. What are the big systemic flaws?
The first one is the underlying business. It's weak. Almost every company doing this is losing money and burning cash in their core operations.
So like strategy software business.
Exactly. Their analytics software segment has been losing money for years, with sales slowly declining. They're basically using a risky asset strategy to paper over a weak core business.
And the funding for these purchases, you said issuing stock and debt. If I'm just a regular shareholder, what does that dilution actually do to me?
That's the critical part. Dilution just means your piece of the pie gets smaller. Your claim on any future profits shrinks. Strategy has been paying the interest on its debt by issuing more and more stock, which just eats away at the value of the shares that you, the listener, might already own.
And that all feeds into the valuation risk, the idea that these companies are valued way higher than the Bitcoin they actually hold.
Absolutely. They have consistently traded at a significant premium to their net asset value, or NAV.
Yeah, what's NAV in this context?
It's just the market value of all the Bitcoin they hold minus the debt they took on to buy it. Logically, the company should trade at that value, maybe even slightly below it.
But they don't.
No. They trade at a premium as if the strategy itself is some kind of high-growth business, and that premium is just... it's incredibly fragile.
So you're paying extra for the privilege of owning Bitcoin inside a company that has a shaky business model propped up by debt.
That's it. And the sources suggest the final nail in the coffin might be Bitcoin itself. The asset is starting to show flaws that go against the whole narrative that started this strategy.
Like what? all we hear is about its revolutionary potential.
The main critique is that it's kind of failed the real-world utility test. Look at El Salvador, where it's legal tender. The sources show the volatility made it really hard for small businesses to price things. And adoption of the Lightning Network for fast, small payments was slow, plagued with technical issues.
And it's not even the best payment network out there.
It's not the fastest or the cheapest blockchain network. Its scarcity only exists in code. And if people start to realize it's not actually a necessity for transactions, the whole investment thesis just crumbles.
Wow. This is a really powerful synthesis.
Yeah.
We've just covered three completely separate sectors: AI, quantum, crypto finance, all on different tracks, but all potentially heading for the same cliff around 2026.
And that shared fate, that's the crucial takeaway for you listening. The common thread here is this severe overestimation of adoption speed and using these extreme valuations to price promises instead of actual verifiable performance.
Right. You've got AI priced as if it's already mature.
You have quantum price as a revolutionary tool when it's still in the lab.
Yeah.
And you have these Bitcoin Treasury companies price as growth stocks when they are just structurally flawed, debt-fueled holding companies.
It really forces you to ask that critical question. Where is real measurable value being generated today versus where is the market just concentrating its excitement?
Exactly. The historical pattern points to delay. It always does. So if these three huge trends, which are fueling so much of the market's risk appetite right now, if they all need years more to mature, it raises one final question for you to think about.
Which is,
What other growth sectors, the ones not even mentioned in these sources, are also being priced for immediate perfection today? And what happens when they inevitably run into that same historical reality of delayed adoption?
it's not about being fearful. It's about applying context to the chaos. Thank you for diving deep with us.